Okay, hello everybody, and welcome back to Warren Buffett Wants to Buy Your Small Business, the place where you can learn to build a fundamentally sound, strong business using the genius of Warren Buffett. Today, I want to talk real quick about return on equity, and the reason why is because it's one of the chapters featured in the upcoming book, Warren Buffett Wants to Buy Your Small Business, which is going to be available in February 2012. So let me just adjust the camera here, and we will bring up the PowerPoint, and I'll jump right in so we can take a look at this. So again, the name of the book is Warren Buffett Wants to Buy Your Small Business. Here's the working cover. Build a powerful asset using the genius of Warren Buffett, and that will be available in around February 2012. And if you want to go ahead and get information on it or stay in tune with what's going on, you can go to smallbizcoffee.com, and you can sign up for a newsletter. You also get a free 320-page ebook if you do that. You can also go to my Facebook page, and that's just it's My Happy Asset at facebook.com. So just go there and befriend me, or like the page, I guess. Here's the websites that are out there already for the existing publications, and I'll just let me zoom out of this real quick. This is My Happy Assets, and this is the instruction manual to reach financial independence. It goes over the nuts and bolts. This is really, in a lot of ways, this is part 2 to Warren Buffett Wants to Buy Your Small Business. That's kind of a prequel, because this goes into the fundamental frameworks that you need to put into a business in order to have success. But Warren Buffett Wants to Buy Your Small Business is really the starting point. Let's go back to the PowerPoint. Sorry about that. And here again are the websites to go to for the books. Lulu.com is where you can order the paperback copies of the existing books. Warren Buffett Wants to Buy Your Small Business should be available at all major retailers. So return on equity, that's why we're here today. That's one thing that Warren looks for in the businesses that he invests in, and it's something that you should have in your business, or if you're going to build a business, you have to be projecting forward that you can achieve this realistically, not just pie-in-the-sky projections. So just kind of running through here, all things equal, a business with an ROE of 20% is better than 10%. And so what that means basically is you take the earnings, which everything that's left over on the income statement, after all expenses, and you divide it by the equity in the business. So the example that I use a lot is, say, a rental property. So if you buy a rental property, you put down, let's say you put down $10,000, and after all expenses, the earnings per year, let's say, are $1,000 in earnings. So you receive rents, you take out property management fees, taxes, insurance, repairs, maintenance, and yard work. $1,000 is left over at the end of the year. So that 1,000 divided by your 10,000 equity is 10%. So you're making a 10% rate of return on that. So you can use that for comparative purposes. All things held equal, an investment that's earning a 20% rate of return is better than the 10% rental property. And point 2 is, why is this so important? And that's because of compounding. I had an example written out here. If you had an investment that was growing at, let's say, an initial $10,000 investment, growing at 10% a year, in 15 years it would reach approximately $41,000. An investment growing at 20% would reach $154,000 in that same period of time. So you see why that's so important. And again, a lot of from where I come from, I think I see it as more of a comparative purpose between investments, and that's why it's important. So I kind of already talked about the rental property example. A business works the same way. You have your income, you have your cost of goods sold, you have your payroll, which should include the owner taking out a salary, and you have taxes that you pay on that. The same thing with your fixed employees, all your other expenses, insurance, taxes, supplies, etc., and then you get to the bottom line. and what is the equity that's within the business. So, so it works the same way. Use your income statement or profit and loss, the same thing. Now, the ideal return on equity, let's look at some Buffett investments real quick. Make sure you can still see this. Yeah, I'll switch to this. So here are the return on equity numbers for 3 Buffett type investments: McDonald's, Coca-Cola, Walmart, and Walmart. And you can see, so this is the past 10 years worth of return. And the way Warren views that is that's the return that he's getting on his money that he has invested. So he views this as, this is my rate of return. And over the long term, in general, people shoot for maybe an average of about 10% in the stock market versus this is what he's looking for when he researches. So what you can see is, take McDonald's for example. Now it had a blip here in 2002, but overall we can see this 17% growing into the 20s. Another little downfall, it probably would have been a good year to buy. 30%. So kind of steady increasing. Coca-Cola, look at that. That's even more of a consistent return on equity through the years. And Walmart seems to be doing about a steady 20%. And here's the averages at the bottom: 21, 32, and 21. So again, so what you wouldn't want to see would be low. Number one, low being. I think the average corporation in America is about 12%. So any ROE, so anything above that is good or high or above average, I guess would be the definition. Whoops. So low, we would not want to see something like 5%, 3%, and over the years, and also kind of sporadic, jumping around or dipping or getting lower. 1% low returns on equity. And again, kind of coming back to the compounding principle, our money can't compound if it's at that level. It can't compound at a great rate. Just trying to get a screenshot. So, and again, the reason why that's important, we get back to compounding. And for a small business owner, that's the question always comes up. So I have to build Coke, or I have to build the next Coke business to be successful. No, that's not the case. You need to be Coke-like. And so how I relate this to small business is, if you're existing, you need to check your existing track record, analyze for this, see if it's there. So you simply would take your end of year tax return, so you take your earnings and then divide it by the equity that was in the business at that year end. So equity is assets minus liabilities is the equity in the business. So do that for, ideally you have a 10-year track record, but if you've only been in business 5 years, you've got 5 years, so do that. And hopefully you're seeing that steady return, and therefore you are Coke-like. Now, and you're something that Warren Buffett would be interested in purchasing. He's not going to come purchase your business, but if he was tantalized, if his interest was piqued, then you're doing something right. So do that examination and see. Now over the years, so you should see a steady, hopefully a high return, something above 12%. Now if you don't see it, then you have to ask yourself, can this be fixed? Can we, earnings, the two components of earnings are revenues and expenses. So can we increase our revenues through new marketing strategies? Can we add new revenue channels within the business? And then can we decrease expenses? One of the things you might want to do to check your expenses is you can get a common size ratio analysis of the income statement from your local small business development centers, and you can see if you're in line with your industry or out. So you might be able to see, our cost of goods sold is a third higher than what it should be. So that's something we can work on. Now if it's a new business, Um, if you are opening a business, and of course there's not a track record in place, so now you're going to have to do projections, and projections are just that. They are a projection, and I always say at best they're an accurate forecast, and at worst they're a good guess. So so you really have to, when you do those, you really have to ask how much faith can I put in it, how much credence can, and that comes from the methods that you use to arrive at it. And there's usually 5 methods out there. I can help you with that, or the Small Business Development Center can help you doing those. But just remember that you're really trying to forecast something that doesn't exist. And Warren Buffett, he doesn't go out and he buys existing earnings. So he is investing in a known factor. One thing I would say, if you're thinking about starting a business, is to take a hard look at franchises, because you can get comparable earnings track records from other locations. Now, that still won't be 100% guaranteed, but at least it's something that's existing in reality that you could base what you're doing on. So that's how you apply it to small business. And again, you want to fix what's in the business. Again, you get back to expenses and earnings. And if it can't be fixed, then you really need to ask the hard question: should we be moving on into another investment that generates a higher return on equity? And then you can go the route that Warren Buffett did with Berkshire Hathaway. The original business was a textile manufacturer, and he was able to he started shifting that capital into other consumer monopoly types of business with high return on equity. So this is one of the things we always get back to, and these are charts you may have seen in the Robert Kiyosaki books, but financial independence, and in context of return on equity, the higher our return on equity, the less capital investment we need to reach financial independence. So that is. And the websites, again, the blog is myhappyassets.info. The website is myhappyassets.com. That's for the original book. That was basically the instruction manual to reach financial independence. Small Biz Coffee is where, if you want to sign up for information on Warren Buffett wants to buy your small business, again, that's due out February 2012. You can get a smallbizcoffee.com. And you can just drop your email in the little sign-up form there, and I'll keep you informed of all the goings-on. You can actually order the previous books at lulu.com and Amazon. I'm going to continue to do these. My intention is every day, so you can just keep checking back here for the updates. And again, here is the book. Sorry, I didn't mean to have these backgrounds on. Again, due out in February 2012, so tell all your friends. Should be at a local Barnes & Nobles near you. And any questions, you can send me an email at adam.brownlee02@gmail.com, or go to the Small Biz Coffee website and drop in, I think there's a contact us form there, or sign up for the list, and then I can get back to you. So that's it. Thanks a lot. Return on equity. You gotta have it. You gotta have earnings first to have any kind of return. So you gotta be able to measure that within your business. So thanks a lot. Have a great day.